$25 billion. Gone. Not in a crash, not in a scandal, not in a recession, silence. Just one decision, a strategy they called bold, visionary, unstoppable. But the moment it launched, the cracks began to spread. Retail partners turned hostile, competitors smelled blood, growth stalled, and investors, they started running. This wasn't evolution, it was a miscalculation. And when giants miscalculate, they don't stumble, they fall. And Nike may still be falling. It didn't happen overnight. There was no explosion, no public scandal, no dramatic apology, just a strategic pivot. Announced with confidence, direct to consumer, higher margins, total control. Nike wasn't retreating, it was restructuring power. For decades, it had built an empire on distribution, retail alliances, shelf dominance, cultural saturation. Every store amplified it, every partner extended it. Then the shift began. Cut the middle layer, own the customer, reduce dependency. It sounded efficient, it felt inevitable. But ecosystems are fragile, and Nike underestimated that partners who once depended on access suddenly competed for it. Stores that once prioritized the swoosh started reallocating space, not out of revenge, out of survival. Because when supply tightens, alternatives expand, competitors filled gaps, new brands seized momentum, retailers diversified, consumers followed availability, and availability shifted. Momentum slowed, not dramatically, gradually, which is more dangerous. Because slow erosion doesn't trigger panic, it normalizes quarter after quarter, expectations adjusted, guidance lowered, language softened, control increased, flexibility decreased. And the more centralized the strategy became, the more exposed it grew. Power concentrated at the top, risk concentrated with it. Nike believed scale protected it, but scale magnifies friction. When a small brand miscalculates, it adapts. When a dominant brand miscalculates, the shock travels through the system. Investors saw the drag, analysts sensed the tension, retail felt the strain, and the market recalculated. Not in fear, in logic, the strategy designed to eliminate weakness revealed one. And once perception shifts, it rarely shifts back. The shift stopped being strategic. It became measurable. Wholesale once drove scale. Now it was cut. Nike reduced key partners, restricted high-demand models, redirected traffic to its own channels. Margins improved briefly. Volume did not. North America slowed. Digital growth decelerated. Inventory built in the wrong places. Control looked efficient until revenue flattened. Retail reacted. Shelf space shifted. Visibility declined. Competitors expanded. Adidas regained leverage. Emerging brands captured segments. Running and lifestyle fragmented. Nike assumed loyalty. But loyalty follows availability. When product disappears, habits change. And changed habits compound. Discount cycles widened. Marketing spend increased. Promotional pressure returned. To defend control, Nike spent more. Spending reduced flexibility. Instead of distributing risk, the company centralized it. One system, one direction, one dependency. When volatility hit, there was no buffer. Competitors diversified wholesale reach, strengthened local partnerships, expanded presence. Nike consolidated consolidation, amplified exposure. Efficiency removed redundancy. Redundancy absorbed shock. Digital growth failed to replace lost scale. Guidance moved lower. Forward expectations softened. Analysts recalculated. Investors adjusted multiples. Valuation compressed, not in panic. In logic, each quarter reduced confidence. Each call lowered tone. The narrative shifted from dominance to transition, from transition to strain. The strategy built for control created structural fragility. Less distribution, less insulation, less margin for error. Scale stopped protecting, it magnified drag. Nike didn't collapse, it tightened, and under sustained pressure, tight systems crack. Growth didn't fade, it reversed. North America declined. Digital expansion failed to offset losses, inventory exceeded targets. Clearance widened, full-price demand weakened. The premium image started slipping. Discounting changes perception. Loud campaigns couldn't mask slowing conversion. Running stores gained traction. Basketball fragmented, new entrants captured niche segments. Direct-to-consumer increased exposure, but it also increased cost. Customer acquisition became expensive. Retention required incentives. Margins tightened. Competitors accelerated product cycles, secured retail partnerships, expanded physical presence. Visibility no longer guaranteed preference. Discovery moved to algorithms. Marketplaces redistributed. Attention. Control over supply did not equal control over demand. Quarterly guidance moved lower. Forward projections were trimmed. Multiples contracted, not dramatically. Gradually, capital rotated. Exposure reduced. Confidence thinned. Nike wasn't collapsing, it was losing leverage, pricing leverage, distribution leverage, narrative leverage, and leverage drives authority. Leadership framed it as long-term optimization. Markets, trade, velocity. Velocity slowed. Expansion shifted to defense. Defense drains resources. Optionality narrowed. The company that once set pace was responding. Response signals weakness. Weakness attracts pressure. The inflection wasn't explosive. It was mathematical. Trend lines bending. Growth compressing expectations, recalibrating at scale. Deceleration signals friction, and friction at this size turned structural. At this point, leadership had two options: reverse course or double down. Reversing meant reopening distribution, repairing strained partnerships, admitting miscalculation. Doubling down meant commitment, fewer intermediaries, tighter inventory, stronger direct ownership. The company chose commitment. Store footprints were reduced, wholesale exposure trimmed further, physical presence recalibrated. The logic was simple: control margin, control data, control narrative. But contraction reshapes perception. When availability narrows, brand energy changes. Scarcity can elevate or isolate. The difference is timing. Nike pushed premium positioning, elevated price architecture, leaned into flagship channels. Yet demand elasticity was thinner than assumed. Higher pricing met softer traffic. Limited drops met selective engagement. Instead of acceleration, there was hesitation. Competitors sensed the gap. They didn't chase hype. They chased access. More doors, more regions, more partnerships. Where Nike reduced, they expanded. Where Nike filtered, they distributed. Market share doesn't disappear. It reallocates, and reallocation compounds, quarter after quarter. The narrative inside the company remained disciplined. Externally, questions multiplied. Is this transformation or contraction? Is this premium focus or defensive retreat? Investors don't wait for clarity, they anticipate outcomes, and anticipation reprices risk. Valuation reflects trajectory, not intention. The strategy was no longer experimental. It was exposed because once commitment replaces flexibility, adjustment becomes costly, and costly adjustments signal vulnerability. Nike didn't announce crisis, it announced confidence. But markets test confidence through numbers, through velocity, through resilience. And resilience is revealed. When pressure persists, this wasn't about one quarter. It was about structural direction, and structural direction defines destiny. By now, the pressure wasn't internal, it was visible. Earnings calls turned defensive, guidance shifted downward, questions sharpened, revenue volatility increased, inventory write-downs surfaced, forecast ranges tightened. The market stopped assuming recovery, it demanded proof. Brand strength alone wasn't enough. Conversion slowed, average order value softened, discount frequency increased, full price momentum weakened. Direct channels absorbed the strain. Customer acquisition costs climbed again. Retention required incentives. Lifetime value models were revised lower. Each campaign produced less lift. Each launch generated shorter impact. Marketing volume rose, effectiveness didn't. The narrative of premium control began colliding with price sensitivity. Higher positioning met selective demand limits. Scale, regional divergence intensified. China decelerated, North America struggled. Europe plateaued. Instead of synchronized growth, there were isolated pockets. Pockets cannot carry global infrastructure. Infrastructure requires velocity. Velocity was absent. Competitors exploited the gap, expanded mid-tier access, strengthened specialty retail ties, secured local relevance. They didn't announce disruption, they executed distribution. Institutional capital noticed persistence, portfolio weightings declined, risk premiums widened, multiples compressed further. Not out of panic, out of recalibration. Recalibration resets expectations. Reset expectations lower ceilings. The company defended long-term ambition, but short-term metrics drive liquidity. Liquidity follows acceleration. Acceleration remained muted. At this stage, the danger wasn't collapse, it was entrenchment because prolonged deceleration rewires perception. Once investors model slower growth, they rarely model acceleration quickly. Confidence erodes gradually, gradual erosion compounds, and compounded doubt constrains flexibility. Flexibility determines recovery, recovery requires belief. Belief was thinning. This is the inflection point, not a collapse. A crossroads. Nike still has scale, capital, brand equity, but scale no longer guarantees acceleration. The question is no longer, can Nike survive? It's whether it can regain velocity, because dominance isn't defended by control, it's defended by momentum. Momentum requires expansion, expansion requires trust, trust requires balance, and balance was disrupted, the strategy centralized power. Now it must restore flexibility, reopen distribution, rebuild partnerships, reignite demand without surrendering margin. That is the challenge. Reversing course signals humility, staying rigid, risks stagnation. Markets reward adaptation, they punish stubbornness. If acceleration returns, valuation recovers. If friction persists, compression deepens. This isn't the end, it's the test. At this size, every adjustment echoes, every delay compounds. Nike doesn't need reinvention, it needs reacceleration. Because in global markets, speed decides relevance and relevance decides survival.